Hey everyone, it's Gio Aritas, the director of the Real Estate Investment Group with Nationwide. I'm here today to talk about a couple of points. Some key points that it's very important that you know, especially if you're either an owner of real estate right now or you are looking to buy real estate, which there's a lot of people right now looking to buy real estate. But just real estate in general, especially if you're a homeowner, these comments that I'm about to make here, these points apply to the entire country, not just Las Vegas, but they do also very well fit the Las Vegas climate. So a couple of main points that you have to know before doing real estate or making a buy or a sell decision in real estate in 2018, no matter where you live in America. A couple of things you need to know. If you haven't read my piece on the 7 things that you need to know that you must know before buying real estate, excuse me, in 2018, I definitely suggest you go read that so that some of the stuff I'm about to say makes more sense and definitely correlate it. But one thing you need to understand is that most of the real estate agents, most of the excuse me, money managers, financial advisors, your brokers, your agents, your teams, most of them have not been alive or were not in the business during the last time that we were in a rising interest rate environment. And that's a real key to understanding what's going on in this market, and any market, any pocket, like niche market around as well, because the advice, the information, the knowledge, the things that are going around right now, there's a lot of misinformation. There's a lot of more than misinformation. There's a lot of incomplete information. And so I think for me, maybe I'll categorize misinformation as incomplete information. But there's a lot of incomplete information. And for a lot of it, it's just the people that are providing this information, they didn't live through it. I happen to live through it. I remember it very well. I was doing business at that time as well. So it's very, very important that you interview whoever you're working with. If it's going to be a real estate agent to help you buy or sell a house, or a real estate agent or a team to help you buy investment real estate, or anybody, your financial advisor, somebody who can tell you what's going on in the bond markets, and why that's affecting interest rates the way that it is, and what mortgage lenders are doing to adjust, if you will, adjust their business models to fit the environment. Lots and lots of topics that you definitely must have a fantastic financial advisor, and somebody that knows their stuff in real estate, be able to really understand the numbers and the correlation between the real estate market and the financial markets, which I do. Spent most of my 20 years in financial market analysis, one way or the other, writing all sorts of different risk management profile models and forecasting algorithms. So you definitely want to talk to somebody. If it's not me, talk to somebody like me. Talk to somebody that has been in the financial markets to help you make your decisions about real estate. Another thing too that people don't realize, number 2, is that the consumer has never had it better. And when you say never had it, in a long time. And to be honest with you, actually never really does apply, because the buyers, the new, every time this age group graduates into, making disposable income or having enough money to be able to put down on a down payment, once you get into that echelon, most of these people have never been in a buyer's market or a buying market before of any kind, and so they have nothing to correlate it to. They're just going off of the information that they receive, which is what we're all doing. But the consumer has it pretty good right now. Even though we're in a rising interest rate market, interest rates are at 4.5%, 4.25%, if you can find somebody depending on your credit score, but 4.5% is what I'd figure your numbers out. And if your real estate agent isn't figuring the 4.5%, the 0.5%, 1/4%, 3/4%, depending on last time you looked, rise in interest rates, you're not getting the full service. You're not getting the full and complete understanding. I'll get to it, the rest of it will tie in a little bit, but let me hit the main points. Another thing, the central bank is holding between, ready for this, 26 and 27 trillion dollars. It is the first time ever in the history of the central bank that they've held this amount of money, and it's in all different formats. It's in all different formats, including debt, which is very, very important to understand. It's a large portion of that is debt. Debt is not a bad thing. Not when you're balancing books, that's for sure. Another thing too, and this is another key element. I wish I could stress this enough to all the clients and all the followers and all the people that have been asking me questions, which, by the way, thank you for all that. It helps on our mission. What we're trying to do is just educate people, have them make better, more well-informed real estate decisions, and decisions in general. But here's the thing that a lot of analysts that I'm seeing are missing, and even the ones on CNBC. I had half of an instance today, or actually this week, to call the producer of one of the shows on CNBC that I was watching and let them know how wrong their information was. The guys that were talking were put up there, and they were watching, and they were talking about the market, and some of the stuff they were saying was spot on, but they got it really, really wrong on a lot of points as well. And they made correlations to times where there was a lot less regulation in the market. We have a lot of regulation in the market right now. You need to understand, this is not the Wild West before. Back 11 years ago was the Wild West, and beyond that, but they've changed that. People and companies are playing by the rules now. So we're not going to see this large dips in prices like it's going to crash, it's going to go back. If you are figuring your calculations on past performance at this point, especially as it turns to values and points that you could plot on a map, on a chart, the fundamentals are changing before our eyes. And new bottoms are being established. As interest rates climb, this is going to be the put-in. This is going to be the actual confirmation of the floor in prices. Very big point. Very, very big point to pay attention to, because people are thinking that we are in a price bubble, and we are not. We are in a rising interest rate market. So until credit goes kabloom, we're going to be going higher, and until credit gets shut down, either through regulation or lawsuits or something else that's going to start, it's going to stop the train. Oh, we need more regulation. We got to stop this now. Until that happens, we're going to be in a rising price market, and everybody needs to understand that. So it's important. It's important because people that are sitting on the sidelines trying to make a decent investment, or trying to make a smart buy, or even a smart sell, prices are going to go up. Now, having said that, you'd think, oh, well, sellers should hold on to their properties. No, it's a great time. It's a liquid market. It's a great time to take profits on investment properties. It's a fabulous time if you're in a profit situation in an investment property. It's a great time. So I want to get through this before it gets too long. It's already 7.5 minutes. But I could talk about this stuff all day, and if anybody has questions, feel free to send me a message or connect with me, and I'll send you whatever information you want. Some of my team will send you some great other pieces of information. But anyhow, so as a result of what I just said, the highs are not yet put in place, and people think that we're on this curve. I'm working on a graphic for everybody, but it's not 100% done yet. So I'll give you, if you've watched some of my previous videos, especially the older stuff, I talk about the wave theory. I'm not going to get into it right now, but we are still cresting. We are not at the peak. We are about here on a peak that's going to I'll do it over here. We're about here on a peak that's going to last between about 3 and 5 years to the peak, and then it's going to dip a little, not much, and then we're heading higher. And that's going to correlate, I say, about 24 to 36 months from the date of this recording. We're going to see interest rates continuing to rise with slowing growth supply. Those prices are going to be on a continuing rise. So my forecast for volatility is that we are going to see steady growth in prices, and there's going to be controlled, slow growth of inventory on the market. Now, if that should change, and stuff can definitely change, if that changes and some big owner sitting on the sidelines, I've heard lots of different names, people that are groups that are owning, banks that are owning, lots and lots of debt in Las Vegas. Who knows if it's real, if it's not real? But for now, we're going to continue to see that. Now, if inventory hits and there's going to be a big blast, we'll notify you. We'll get a heads up on it before it actually crashes and burns. I'm doing my best I can not to swear on those points, guys. But we're going to see this slow and steady growth continue for about 24 to 36 months, 2 to 3 years. I said it incorrectly before. 2 to 3 years before we hit this trough. The trough will probably last a solid year. That will depend, the length of that trough will depend on the amount of available inventory at the time when we start to peak, like right in that smack dab, that 24 to 36 month time where we're just starting to see this thing start to crest and it's going to coast, and inventory. Lots of properties will come into the market. You need to be ready to buy, because the sellers will think that that's their high and they're going to crash from there. So they're going to sell hand over fist. Everybody's going to pick up some really good prices as the market dips. So right after 36 months, and then boom, guys, we're going to take off. And you're going to see average home prices in this town go, and everywhere across the country, if you're not at $350,000, the limit that was set by Fannie Mae in a couple of months back, and the FHA limit got raised. We're talking about average prices that are going to be average in the 350s. Why? Because the governments and the central banks have said that this is the value that Fannie Mae is going to insure. Up to $350,000. I mean, we're at a place right now in Las Vegas. Average price here is $250,000. It's the best time to buy real estate in Las Vegas. You should be buying it hand over fist. You should be buying it to invest in, hold on to. I've got 2 investors that have great business models. They buy property now. They wait a couple of years as rents continue to rise in this interest rate rising market. And then boom, a couple of years later, they go in, they fix them up, they put them on the market, they push the market up, they get top dollar. Great business model. It's been working wonderfully here. I think that's it. Let me just double check, guys. Yes, anybody that stood around for the 11 and a half minutes, thank you. I hope that this was very helpful and very useful to you all. If anybody wants more information, or if you're an agent, and I don't care what city you're in, if you want to act more like this and operate your business more like this, reach out to me for information about our referral network. All right, everybody, peace out. Have a wonderful weekend if I don't talk to you guys again. Ciao.